Good morning, Mandy. I think the Fed is just waiting now. They're in a wait-and-see mode. So I think they've paused, but they haven't pivoted yet, meaning that they need to see the effect of this 500 basis points rate hikes over the last year and a quarter. So the inflation numbers have come down, 4.9% CPI, but they're nowhere near the 2% target they're talking about for a while. So I think the Fed will pause. Our house view is that no rate decreases for this year. It may wait till next year. But, however, the big caveat is if we have problems in the regional banks and credit conditions really get worse because some of the regional banks encounter problems because of their commercial real estate holdings, then all bets are off and maybe more liquidity will need to be injected into the market.
I'm really glad that you raised the issue of what's going on in the regional banking sector, because I was reading one piece of analysis that was saying if the Fed was in a position where they had to cut rates so soon after just finishing their hiking cycle, something really bad would have had to happen, meaning that if they do cut, it's actually quite bearish for the markets. Do you buy into that?
There is something to that, actually, because if it's a slow and steady soft landing, they probably would not need to cut that for the rest of the year. But if you do have a big problem in the regional banking sector, so not 3 or 4 banks falling, but let's say 20 or 30 banks encountering problems because they have $450 billion of commercial real estate loans that need to be refinanced this year at a much higher rate than they were made previously, then the Fed will need to act. It'll be more urgent, and then the market may not take it as well because it'll be a risk-off sentiment for sure.
So while
I would say that's a little bit different than the debt. Sorry,
keep on going, George.
Sorry. I was going to say that's more of a systemic issue for the financial system. You know, the KBW bank index in the U.S. is already down 26% this year, but it could go even further. That's a little bit different than the debt ceiling talks, which is binary. That will end sometime in June or July. But the regional banking crisis could last a bit longer.
So that's one brick in the wall of worry. There's another brick in the wall of worry right next to it, and that is the Chinese economy losing momentum? And certainly the stock market is reflecting that, coming off its April highs. But it seems like you've got two very different stories going on in the two biggest economies in the world. On the one hand, in the US, you've got high inflation but low unemployment. In China, you've got almost no inflation or very little inflation, but very high unemployment. How do we work our way through these?
It's very tricky because almost this whole year we've been waiting for these two big ships to pass in the night, almost like the U.S. to slowly drift into a recession and China to slowly recover, and neither has really fully happened yet. In China, I know we're waiting for the retail sales numbers today, and I'm sure they're going to look relatively good, but you're comparing it to in April last year where Shanghai was in the middle of a lockdown. So the base rate is very, very low, and all the numbers are not that positive for this early stage of economic recovery. So CPI shouldn't be at 0.1% growth when the beginning of a recovery. PPI shouldn't be down 3.6% last month. So the aggregate demand doesn't seem to be there.